Go.
Hello, my name is Mecca Cortez. I'm a finance major at Southeastern. I'm going to be doing my financial analysis project. For this project, we had to analyze 3 companies. For these 3 companies, I chose Steve Madden. They're a shoe retailer. I also chose Lionsgate. They are a entertainment company, and Hornbeck, who is an offshore oil company. For this analysis, we had to choose which company we would give a 6 loan to, what company we would give a 5-year loan to, and what company we would buy half of. And so, for my first question, what company would I make a 6-month loan to? I'm going to be using my cash ratio. Now, your cash ratio is cash over liability, and your cash ratio shows how much assets a company has on hand in order to pay back short-term liabilities. Short-term liabilities, and your current ratio, which is assets over liabilities, shows how much total assets a company has in order to pay back its liabilities. And your quick ratio is going to be assets minus interest over liabilities. So, Steve Madden is up first, and across the board you can see that their cash ratio is pretty low, but somewhat stable. They drop a bit in 2011 and 2014. But their current ratio is very stable across the board, showing a slight increase in 2012 and 2013, but they also fall a little bit in 2014. Now their quick ratio is the most stable of all 3, though they do decline a little bit in 2013 and 2014. On to Lionsgate, they have very, very low cash ratio, which is not a good thing, and their current ratio is also low, but somewhat stable. Their quick ratio, again, is pretty low, but all 3 ratios are still very stable even though they are low. Now with Hornbeck, they have the highest of the ratios. In 2011, they increased a good bit, but they also fall again in 2012. With the industry that Hornbeck is in, it's not surprising that they have very volatile ratios. Their current ratio is also high. And again, they spike in 2011 and fall in 2012. Their quick ratio is also high, but not very stable across the board. This is just a graph showing the cash, current, and quick ratio. Here we have Hornbeck in first place, their highest. And we have Steve Madden second, and Lionsgate last. So what company would I give a 6-month loan to? I would definitely give it to Hornbeck, because even though other companies had more stable ratios, Hornbeck definitely had the assets to pay it back, and if I'm giving a loan, I want to make sure I give it to someone who I know has the assets to pay back the loan. The next question is, who would I make a 5-year loan to? For this, we're going to be using our long-term solvency ratios, and that's equity multiplier, assets over equity. Your equity multiplier shows how much risk a company takes. Also, we're going to be using our times interest earned ratio, which is EBIT over interest. Your times interest earned ratio shows how the ability that the company has to pay back the risk that it's taken. First, we have Steve Madden, and their equity multiplier is somewhat low, but it is very stable, which is a good thing, so they're taking out a small amount of risk. Here we see with their times interest earned ratio, it's very, very high, so they have no problem at all paying back the risk that they're taking out. Moving on to Lionsgate, their equity multiplier is exactly the opposite of Steve Madden. It's very, very high, and it shows that it's decreasing over the 5-year period. Their total interest earned ratios are very low, which is not a good thing. So they're taking on an extreme amount of risk to not get much return, to not be able to pay it back. Hornbeck, we see that they also have stable ratios across the board, and they also have higher equity multiplier than Steve Madden. Their total interest earned ratio is somewhat low, but it is higher than the equity multiplier. So they're taking out a good bit of risk, and they're also able to cover that risk. So who would I make a 5-year loan to? I'm going to have to make a 5-year loan to Steve Madden, because though Hornbeck had very stable ratios, Steve Madden definitely had the times interest earn ratio, that was very high, so that shows that they're taking out a very small amount of risk and they're able to pay it back. The last question is, what company would I buy half of? So for this, we're going to be looking at our return on equity, and that's going to be profit margin times total asset turnover times equity multiplier. Your return on equity shows how much profit the company is making from the money that they're getting from the shareholders. Your return on assets, which is net income over assets, and your total asset turnover here is your sales over asset. Total asset turnover is showing how efficiently the company is using its assets. Your price earnings ratio is your share price over earnings per share. This is how confident your shareholders and investors are in the company. And your profit margin is net income over sales. All these ratios you want to be very high. First, we have Steve Madden. Their return on equity across the board is very high, but they show a very steady decline as well. So that's something to note. That if you're trying to invest in a company, that's something to note, because you don't want to invest in something that's not getting a lot of profit from the money that you're putting into it. Your return on assets is high, but again, it's steadily decreasing over the years. Your total asset turnover is low, but it's probably the most stable of the two ratios that we've seen so far, without declining so much in the past couple of years. Their price earnings ratio, again, is high. They were pretty low in 2010 and 2011. They increased a bit in 2012, but dropped off again slightly in 2013 and 2014. Your profit margin is pretty high, and these are pretty good numbers, but again, they're steadily decreasing, so that's something to definitely watch out for. For Lionsgate, your return on equity is negative for the first 3 years, which is very, very bad if you want to invest in a company. In 2013, they had this huge increase, but that didn't really last long, because in 2014, they fell off again by a huge amount. Their return on assets, again, the first 3 years, it was negative. They jumped again in 2013 and again fell in 2014. Your total asset turnover is steadily decreasing at the end, but the most stable of the ratios here. Your price earnings ratio is somewhat high, but also very volatile, jumping up and down. And your profit margin here is very high. It's higher than Steve Madden even, but it's very high. Okay, from Hornbeck, your return on equity, you have pretty low ratios, and they had 1 year where they had negative return on equity. Your return on assets, they're very volatile across the board as well. Your total asset turnover, these are very low, but they're pretty stable over the years, dropping slightly in 2012 and 2013, but going back up again slightly in 2014. And your price earnings ratios, the 2010, 2011, and 2012 were not in Bloomberg, but from what I can see in 2013 and 2014, they did increase quite a bit. So for whatever reason, their investors are having a little bit more confidence in them. And your profit margin is high, but again, not as high as Lionsgate or Steve Madden. What company would I buy half of? It was very tempting for me to pick Steve Madden because they had the highest ratios of all the companies, and they had the highest ratios of all the companies, but they were very much steadily decreasing in all of their ratios. And as an investor, you don't want to invest in a company that's steadily decreasing over the years, because 5 years from now, where could they be? So I'm going to say that I would buy half of Hornbeck, because I would rather ride the roller coaster of volatility with a company that I know at some point will get a big return, even though they may drop certain years. So I'm going to pick Hornbeck. Thank you.